Statement of cash flow. That's IAS 7. Statement of cash flow. All what you need to know about it. So IAS 7. Statement of cash flow.
Statement of cash flow. Good. So let's see how we can do that. Good. So statement of cash flow. That is it. Statement of cash flow. Now, before we got into detail of IAS 7, we'll probably have to answer some few questions that will probably give us or expand our knowledge in cash flow preparation. Now, is profit equal to cash? That's the question I'll ask. Profit, will it be equal to cash, your cash balance? Yes, so most case, no. Most case, no. Only few cases. So in our case, no. Profit is not equal to cash. Good. Profit is not equal to cash. Profit, which statement? Which statement can you see profit? There. Which statement? You can see the profit in what? The profit and loss statement. Good. What about the cash? Cash, you can see it in your cash book or the financial position. That's where you can see the cash balance there. Good. Now, the question is, why are they not the same? Why are they different? Yes. Where are the figures? So the issue is this. How you prepare profit and loss, the assumption, the principle behind to prepare profit and loss, though they are the same, but a slight difference. Yeah, so it end up giving us a different final answer. So that is it. Now let's look for specific causes. Specific causes. Now the issue is that the causes of the difference, I have grouped them into three. Only three issues. As soon as these three transactions occur within the year, definitely your profit will be different from your cash balance. That's it. Good. Now, the first item I'll talk about it is non-cash item. Not cash transactions. Now, with non-cash items or non-cash transactions, they are the transactions that they occur, but does not have cash effects. Cash has not moved, but if occur, such transaction will have impact on the profit, but it will not affect the cash. So it will cause a difference between your profit and then your cash. Yes. Let's give a specific example of non-cash transaction. Depreciation. When you talk about depreciation, it's an example of what? Non-cash item. Public depreciation will be subtracted from the revenue or from the profit before they arrive at what the final profit called the profit after tax. Meanwhile, depreciation has not been subtracted from the cash. Why? Because depreciation is what? Non-cash item. So it will create a difference between the profit and then the cash. Another example of non-cash item are, the other examples are bad debts, inventory written down, When we saw the preparation of the financial statement, if your inventory, the part of the inventory is being written down, that one we've not probably paid for, it's an expense. that we have not probably paid does not have cash effect, or cash has not yet moved, but it's a provision. And you can also talk about provision unless it has been what crystallized. So basically, these are the examples of non-cash items. There are many. It also talks about impairment, amortization, depreciation, impairment, amortization. All of them, they are non-cash items. Good. So that is it. Okay. Now let's probably move on to the courses. So here we are saying that the difference between your profit and cash could be caused by a non-cash item. That might reduce the profit. Yes. So that is it. Now another example of non-cash item is the gain. Some of the gain that you have added, they are not cash flow. Oh yes, some of the gain are not cash flow. Some of what the gains are not cash flow. So assuming that there's a fair value gain on investment property, it will probably add it to the other income. When there's a fair value gain on investment property, you add it to other income. Meanwhile, there's no cash flow. There's no cash flow of it. And sometimes too, they figured out some of the transaction, though there was cash, but there's non-cash item. The figure that we are going to record for the cash element is materially different from the profits. Yeah, I'm going into detail. You can have something like profit or loss on disposal. Now, when you calculate the profit or loss on disposal, it might not be the same as the actual cash that you received. There will be difference, and this can also cause difference between your profit and your cash. Good. So that is it. Now let's move on to the second point. So these are few examples of non-cash item. They will definitely cause a difference between your profit and cash. Good. So now let's move on to the next item. I'll talk about accrual basis. Accrual basis of accounting. Because you are using accrual basis, they'll be different, always different. There will be always different between what? Your profit and your cash. It will cause a difference because of the accrual basis. What does the accrual basis say? It says that transaction and events should be recorded as and when they occur, but not when cash has moved. So transaction can affect the profit, but will not affect the cash. Example, anytime you owe any of the expenses, you probably add it to the expenses incurred for the year, and finally you subtract it. So expenses owing are subtracted from the profit. Meanwhile, expenses owing, because cash has not yet moved, we will not subtract it from the cash. It will still be intact, because let's assume that your sales revenue for the whole year is 8,000, and then that's your first time starting business. Out of this 8,000, let's assume that all of them were cash. All of them were cash. Good. But your expenses, total expenses incurred, was 7,000. Out of the 7,000, you have paid what? You have paid only 5,000, so you are owing for 2,000. Now the issue is that in a P&L, we will show total expenses incurred of 7,000, giving us a profit of what? 1,000. Meanwhile, our cash balance will be what? What will be the cash balance? Out of the 7,000, we pay 5,000, right? So we have received 8,000, but we've paid what? 7. So the cash balance will be cash received from sales, 8,000. Expenses paid, we paid only 5,000, so we are owing 2,000. So therefore, our cash balance is what? 3,000. Good. The profit over here, which is what? 1,000, is not equal to this 3,000 because of the accrual basis. Now hear me. If somebody is using the opposite, that's the cash basis accounting. With that one, profit is always equal to cash with a cash basis. For instance, this transaction, how are you going to record it if you're using a cash basis? You are going to record only the cash element. Yes, 8,000. So for the profit and loss, for the P&L, it will be like this. Sales, it still be 8,000. Now the expenses, you have to bring the expenses paid. Sales, they've received it. So that one, I'll bring full amount. But here, they've paid only 5,000. So I have to show the 5,000. So finally, their profit will be what? 3,000. Which is the same as what? The cash balance. So if you are using the cash basis accounting, the profit will always be equal to cash. But because you're using accrual basis, sometimes transaction will occur today, but there's no money. They didn't give us the money, but we have to record it because it does occur today. Such transaction will cause a difference between today's profit and today's performance. Today's profit and today's what? Today's profit and today's what? And today's cash. Yes, I like that. Today's cash. So that is it. So good. So accrual basis. So it means that anyone that use the cash basis, you won't have any difficulty. So it will not be any different. Now the third one is capital expenditure. Capital expenditure. We all know that capital expenditures are like expenditure that you incur. They are the amount that you incur to either acquire non-current assets or to improve. So in simple quote, they are the amount that you incur to what? To get or acquire a new non-current asset. So when you go and buy a new asset, it's a capital expenditure. Why would this cause the difference between your profit and cash? If you buy it on credit or if you buy it through public cash, if you acquire capital expenditure on cash base, like you bought an asset, you pay on time. That very day you paid, what will be the transaction? Your cash will go down because you're going to use cash to pay. What about your profit? Profit will be the same because your profit will not be affected because the asset that you've acquired, it will not go to the profit and loss statement. Yes. So that is it. So they will cause a difference. And then probably loans. If you go and then acquire loan, if you take loan, it will increase your cash, but your profit will be the same because loans are not on the profit and loss statement. So that is it. So basically, any item that which is on the financial position but not on the profit and loss causes difference between it. So that is it. Good. So take note first. You can also talk about public raise of shares. If you raise shares, you get some funds. Cash will increase, but profit will not be affected. So all of this can cause what? Difference. So basically, that is it. Good. I hope there's no question. There's no question. Let's move on. Now that we know that profit is not equal to cash in most cases, then there's a need for us to reconcile the difference between the profit and the cash. So when we prepare the financial statement, we cannot be explaining things like this for them. No, they won't understand. All what they understand is what? Money, figures. You have to use figures to explain. So, in effect or in short, we prepare the statement of cash flow or prepare the cash flow statement to just reconcile the difference between the profit and cash. We prepare the statement to explain how we arrive at the cash, our cash balance, so that they will be like they will know the composition. Other than that, if you are an accountant of one-man business, you are in trouble because if you go and declare a profit, the profit after tax, let's assume is 50,000, and then your boss will ask you, the CEO will ask you, please, what's the cash balance? This is our profit for the year. Our cash balance at the end of the year is what? Just 10,000. And the boss asks you, so where's the remaining 40,000? Yes. You can't be saying that, boss, non-cash item, accrual, capital expenditure. You're wasting his time. You will understand. Use figures. how this 10,000 was arrived. That's all. How the 10,000 was arrived. You explain to use figures. You understand it far, far better than this. So the main reason for the preparation of cash flow is to what? Reconcile the difference between the profit and then the cash. So it explains into detail how we arrive at the cash of 10,000, so that the owner or the any user at all reading the information will be satisfied. We'll not say, this one there's something inside. Oh yes, those terms. Yes, there's something inside. There's nothing inside. Good. So that is it. Now that we know that the main objective of cash flow is to probably reconcile the difference between profit and cash. Now let's go into it and then start the cash flow. Now with cash flow, the organization's activity has been grouped into three perspectives. So when you add the cash flow over there, then you are done. So for cash flow purposes, the organization's activity has been grouped into three perspectives. Organization activity has been grouped into three perspectives for cash flow purposes. One, we are saying that cash flow from where? Operating activities. Cash flow from operating activity, that's one. Two, cash flow from where? Investing activity. Investing what? Activity. Finally, cash flow from where? Financing activity. Please, no shortcuts in exams. So that is it. So basically, if I get these three answers, put them together, this will give me the cash flow for the year. So this one means the entire cash flow that we have probably derived, the net cash flow for the year. You add the opening balance to it and get the closing balance. The users will be happy. Now, let's go into details of each of the perspectives. Cash flow from where? Operating activity. Cash flow operating activity. Good. Give me a second back. Good. So cash flow from operating activities. So that is it. Now, when we talk about cash flow from operating activities, what are the items that do we have to consider? What are the items that should form part? Because each and every item, each and every perspective have its own specific item that we have to use. I'll be get that. Good. So when you talk about cash flow from operating activities, it talks about one, in fact, basically your principal activity, your core, your ordinary course of what? Business. Ordinary course of business. What you register your business for. If you register your business to buy and sell probably tomato. So cash flow from operating activity means cash flow from tomato, sale of tomato. That's it. Money that you derive from sale of tomato. Not the other business, not the other area. Yes. The secondary sources. So we are looking for the primary. That's the operating activity. So basically, it talks about cash received from customers. Cash what? Received from customers. Cash received from customers. Two, cash paid to suppliers. Cash paid to what? Suppliers. Yes, cash that probably you pay to your suppliers. Then three, operating expenses paid. So operating expenses paid. Operating expenses paid. Now you know these operating expenses paid, right? It includes the admin, distribution, yes, wages and salary. All these ones are operating expenses paid. That's the operating expenses paid. Good. Then you can talk about interest. Interest paid. Now let me ring this one because it's a stubborn guy. Lastly, tax paid. So tax paid is what? An operating item. Though nobody register his business to be paying taxes, like they should down the line where this tax form may call topical issue. So it's some part of the operating activity. Everybody, every company pays tax. So it become operating automatic. So for tax paid, it's an operating activity. Good. So that is it. Now these are the cash flow from where? Operating activities. Your operating activities. Your core purpose, your mandate. Now this interest paid, if you have registered your business to be dealing with interest related transaction, you are like a finance company. You give loans and accept deposits. Oh, then the interest that you are paying on the deposit is your main activity. It's your principal activity. It means that you're a financial institution or you're a bank. So then it should be under what? Operating activity. But if you know that your principal activity deviates from paying and receiving interest, then please, when you pay interest, it is not an operating activity. Oh yes. Let me give you an example. Have you seen the motor vehicles, features, and the non-current assets? It is somebody's what? Stock. Somebody's trading stock, the non-current asset. The building that when you acquire one, you say, yes, you are the champion. If somebody's inventory, have plenty that he's selling it. Have you seen it? Good. So you are going to account it as what? Non-current asset. But that person will account as what? As inventory. Good. So that is it. The motor vehicles that when you buy one, think you're on top, or when the organization buy one, that like they will showcase it because they have the nicest truck ever. But that truck is somebody's what? Inventory. You have a lot of them that he's selling. I've seen it. Good. So such a person who manufactured the truck, it becomes operating activity. But for you, it's not operating activity to you because you don't deal in buying and selling of what? Trucks. You don't produce truck. Just need for just one. I'll be get that. Good. So that is it. So if you deal with interest-related transaction, then it should form part of your operating activity. Usually the financial institution. Yes. Good. I'm done with the operating activities. I'm going to the investing. Now let's go to investing activity. Where can you see this? I'll explain after all of them. Now let's go to investing activities. I hope there's no question, right? Good. Kindly put the questions on the screen for me or just put them in the suggestion box or the comment box. I'll pick it up. Now, when you go to investing, investing talks about the opportunities that probably you took advantage of during the year. So it includes buying and then selling of what? Assets. So acquisition of non-current assets. So investing activity basically talks about non-current assets. How you buy non-current assets and then how you dispose them of, any return you are getting on them. It includes investment on all of them. So that is it. Good. So good. So first we talk about acquisition and what? Disposal. Oh yes, you buy, you sell. Non-current asset. Good. So acquisition or disposal of what? Of non-current assets. So of non-current, that's the first one. It's a financing activity. Anytime you buy or sell your non-current asset, why is there financing? Because if not register your business to be buying and selling what? Those kind of assets. So that is it. 2, acquisition and disposal of long-term investment. Long-term investment or just investment. How do you get that? So acquisition and then disposal of what? Investments. So if you have, let's say, a long-term investment during the year, you dispose parts. Yes, it's a financing activity. Yes. And then you acquire more investment during the year. You invested more. Now this is a financing activity. So that is it. Third one, go to the other income. Any items, any cash flow, which is in other income, should come here. Any cash flow, which is in other income. So here will be interest received. Interest what? Received. Interest received. Dividend received. Dividend what? Received. Dividend received. So that is it. Now with the interest paid, I will also explain it when I get there. So take note. These two, they may swing. They may be an operating activity, the interest received and the dividend received. All of this depending on the nature of your business. If the nature of your business deal with interest related transaction, then interest received too it will form part of your core activity or your operating activity. If the nature of your business you deal with dividend related transaction, then dividend received should be form part of your operating activity or dividend paid. So take note. But here we are going to assume a trading company. We are going to assume a pure trading company. So take note. With one assumption. So that is it. So basically these are what the other income. I have to look through for the question. So I'm done with the investing activity. So if you have any question, kindly drop them on the screen and then let me pick it up. Good. So we are done. Good. Now let's go to financing. Financing basically talks how you get what? Funds to support your operating activity and investing activity. How do you get funds to finance what? The operating activities, your core purpose. How do you get funds to go and then buy your goods, sell your goods, buy the asset that you want to probably buy? In fact, if you want to talk about financing, just two items. Oh yes, as you saw under the ratios. One, equity, check the equity item. So equity items and long-term debts. Long-term what? Debt, that's all. So any transaction that relate to this, but make sure that they don't form part of your core activity. So now let's go to financing and also do justice to financing and then you'll be fine. So for financing activity, oh, why? It's already there. Let's go straight to the examples. So one, we have issue of what? Shares for cash. Oh yes, I have to say for cash. Why? Because sometimes you can issue shares for free. Oh. So bonus share, deemed dividend, all of them are there. So take note. Not every issue of shares that normally raise funds. Some of the shares were issued for free, or most of them are issued, or sometimes some of them are issued for free. So take note. Okay, so that is it. Issue of shares for cash. Good. Now, we can also go to transaction cost or issue cost. Either transaction cost. But let me hide that one. I'll do it once. Let me go to issue 2. Issue or repayment of what? Of loan or debt. If you go for debt, probably new advance, top up your debt, or repayment of debt, all of these are financing activity. Then, if these two are the major financing activity, any transaction that relates to these two, they also form part of financing. Now, what are they? So, have you seen that? You've seen the clue. So, issue cost. I'll talk about issue or transaction cost. Transaction what costs? Oh yes, issue cost. Normally, when you issue the shares, you may incur some cost, printing, receipts, other stuff, administrative processes, legal processes, all these fees. That's the issue cost, right? Good. Now you go to transaction costs. Before you probably go and then pick a loan or go for an advance, probably go through some transaction costs. You incur some transaction costs. That's the administration fee, processing fee, and sometimes I personally cost go and come. Oh yes, your transportation will toss you. Yes, bring these documents, bring it before they can give you the loan, but they'll let you bring all your documents. And then yes, that's the cost that I'm talking about here. Administrative process, all of them form part of the transaction cost. Good. Fourth one, dividend paid. So dividend paid should be here. Good. It may also swing, but let it be here. The fifth one, interest paid. Here, let me put asterisk. Hey, why have we presented interest paid 2 times? Yes, because it can be here, or interest paid can be a finance activity or operating activity, depending on the nature of your business. But most often, let's try and then put it under the operating activity. Now, the issue is that if you are not an interest-related organization, or your transactions your principal activity does not involve paying or receiving interest, then the interest that you are paying on your loan, then it's on financing. Some organizations, they don't even go for loan, they will still pay interest. Oh yes, the financial institutions. But some organizations, you only pay interest when you go for what? Loan. When you go for finance, so it should be under finance. So that is it. Now let me give you a classical example. Bank. If you take bank, for instance, yes, they don't normally, whether they go for loan or not, they still pay interest because on customers' deposits. Yes, customer deposits. So it means that interest payment, it becomes their core activity. So such interest, or the interest that they've paid the whole year, should form part of their core activity. That's the operating activity. But if we're a trading company, you only pay interest if I've gone for loan. So the interest will be on your finance activities, not your core purpose. Good. So that is it. So this is the idea behind the preparation. Good. Now I'm done. So you can see, this is coming from the profit and loss, the P&L. This is coming from the non-current asset aspect on the balance sheet. And this is coming from equity and what? Liability. We have balanced the equation. Oh yes, the equation is balanced. Which equation? The accounting equation is balanced. How? The accounting equation is balanced. Profit and loss, the profits, operating activity, declare the performance. Invest in non-current assets, financing, equity and liability. Equity and non-current liability, then we are done. So that is it. Now question time. Any question for me? If there's no question, let's probably move on. Okay. Now let's see. Now let's pick each of them and then learn how we can prepare each of them. Now, preparation is so simple. If it is inflow, we are going to use inflow and outflow. Inflow means money is coming in. When money is coming in, what do? You add. When money is moving out, you subtract. That's all. So you check. For instance, issue of shares for cash. Is money coming in or money going out? Okay, it seems like money is coming in because when you issue the share, cash should be received. Good. So money is coming in. And as soon as money is coming in, is what? Inflow. So inflow you add. And then outflow, you do what? You subtract or put it in brackets. Good, so that is it. Now, there are 2 methods with regards to the cash flow from operating activities. So how to prepare the operating activities? There are 2 methods. But for financing and then investing, there's no alternative method. They are just one way. Good. So let's go through the cash flow from operating using the two approaches. So let's see. Good. Okay. So cash flow from where? Operating activity. How we are going to prepare it. There are two methods. There are two methods. We have the direct method and then indirect approach. So we are going to use the direct method. So direct method. Direct method. Good. Okay, with the direct method, cash flow from operating activity. So cash flow from where? OA. Please, no shortcut in exams. Take note to no shortcut to. So cash flow from where? Operating activities. Here isn't the direct cash flow. Direct means they don't bring profit inside. Don't bring anything like profit, not at all. Pick direct cash flows like physical cash. Don't use like any other means converting something to something before you can get the cash. No, not at all. Here direct cash flows. So what do? Then you pick cash received from where? From customers. From your customers. Cash from customers. So much. How we get it? So we are drafting the format together. We are drafting the format together. In fact, have you seen the examples that I gave? How I arranged the examples? That's how we are going to do it. The examples that I gave, that's how I'm going to do it. Cash paid to suppliers. Cash was paid to suppliers. So much. You less because an outflow. Money what is going out. Then you go to expenses paid. Operating expenses paid. Operating expenses what? Paid. Down to less. That's all. You get this one? It have a nice name. You call it what? Net cash flow from operating activity before what? Interest and tax. Because this is your sales revenue. This is your cost of sales. So sales minus cost of sales is what? Gross profit. Finally, gross profit minus operating expenses. That gives us what? Operating profit. So this one, it's equivalent in cash, in monetary terms, or in cash flow terms. It is called cash flow, net cash flow from operating activity, right? Before interest and tax. Because in cash flow, we don't have other income. In operating activity, there's nothing like other income. Yes, because all the other income should go to investment activity. So take note. So here you call it cash flow from operating activity before interest and tax. But normally I call it operating cash flow before what? Before interest and tax. Good. So that's the name. Then what do? If this cash flow is before interest and tax, then you go interest. Interest what? Paid. And tax paid. Don't forget that the interest paid can also be under what? Under financing. So tax paid. Good. So that is it. Tax paid. Okay. So this will be the format that we are going to use. Everybody should capture it for me, and then you'll be fine. Please, no to employee. What we have to do is we have to understand the format. This is not a format. This is not a formula. Please. If you go to probably, if you go and ask the Makula woman, she can tell you all this, but no standards, no IAS 7. She can tell you that the whole year I've received 254,000 cedis from my customers. Me too, I paid 100,000 cedis the whole year. So, and my expenses, I paid this. So this is the net amount. That is it. So it means that if they can do that, then we have to do more than that, right? Yes, because we have book. We even have standard. They don't have standard. They can do. They don't have IAS and they can still do it. How much more we that we have IAS? Yes. So that is it. They belong to their profession. Yes. So we too, that is it. Okay, so any question? If not, I'll start my first illustration. But before I start the illustration, let me explain some few items to you. And let me explain the trick behind this. Only 3-step approach, you are done. Only 3-step approach, you are done. Good. Now, if you want to get a cash receipt from customers, you're supposed to apply something that they call it control account. Don't worry. If we have no idea about control accounts, we can still prepare it. So what we do is this. When you pick, anytime you want something paid, something what paid. Anytime you want something paid, so like cash received, paid, expenses paid, tax paid, paid. Oh, so I mean that they paid that plenty. Paid. In fact, everything over here is paid, right? That's good news. So the trick is that if you want something paid, don't worry. Bring that item, its open balance. What can cause that item? Add less the closing balance. You are done. So nice. So I'll test this trick on what? On the customers. So if you want something paid or something received, paid or receive, paid or receive. Good. The trick is it. Bring the open balance of that item. Where can you get the open balance? Go to the financial position. The open balance. Add that item. Add what? That item. Add the item to it. What can cause that? So for instance, if it is cash received from customers, what can cause cash received from customers? It's what? Credit sales. Oh yes, because if they don't buy from me on credit, I may not be able to get what? Yes, I'm not be able to get the cash received from customers. So that is the total cash received from customers. So take note of that. In fact, if there's cash paid, don't forget to bring it to or cash sales. So normally you can add cash sales to it. You can create a column on its own and put cash sales. You have to add the cash sales to it. So the item, that's the credit sales. So much. And then the closing balance. Normally the closing balance, they've not paid it. Oh yes, at the end of the day, some of them are still owing you. They've not paid the money. So that one, you take it off. So this is what they've paid. So this is the trick behind. So if I should do it well and start a specific version, then it will be something like this. So I'll say cash received from where? Customers. Open balance. So you have to use debtors or receivable. Debtors balance or receivable. Open balance of debtors. Wow. Open balance of what? Debtors. Good. So what do you do again? What can cause receivable? Tell me. What can cause receivable? Good. What can cause receivable? Yes, when you sell on credit. Good. So bring the credit sales. So here the item is what? Credit sales. So I have to bring credit sales. If there's cash sales in your question, after getting your answer, you add it to it and get the total cash received from customers. Or you can pick your total sales here. So either credit sales or the total sales. But ideally, when you pick the credit sales like this, when you pick the credit sales, when you are done, it will only give you the cash you have received from your credit customers. So when you come to the phase, you have to add the cash sales to it. So even if I should add it here, to be good. So cash what? Sales. Good. So that is it. Now, I think I've solved the issue. Okay, so credit sales. Then you come to closing balance. of the receivable figure. So this is what we call cash what received. The same thing, if it is payable, that will be cash paid. Open balance. That one, what can cause payable? That's the credit purchases. So that will be credit purchase, not credit sales. That's all. Closing balance of payable. The same show. Add open balance, add that item, less the closing balance. You get the paid or received. You are done. So have you seen the three approaches? It makes cash flow look what? So easy and so straightforward. Good. Normally we're supposed to use T account, but here we have banned T account. We are using the statement version, so you'll be fine. So that is it. So the same thing applies to all of this. The same thing applies to L. So if you're looking for expenses paid, don't forget the same show. If you're looking for, but the expenses paid, I will explain it into detail. Let me go to expenses paid because cash paid is the same as what we've done here. Now, when you go to the expenses paid, basically there are two items, or there are two different types of expense. We have expenses incurred. Good. And we have the expenses what? Paid. Paid. What's the difference? Expenses incurred. Expenses incurred. It also means expense. Now, expenses incurred is what you have what consumed, what has occurred during the year. But the paid, the cash movement. Good. Here we want expenses paid, not expenses incurred. So sometimes it may include non-cash item. Non-cash what? Item, such as what? Non-cash items such as oh yes, we saw non-cash items such as depreciation, provision for bad debt. All of these are what? In the operating expenses, but they are not what? Cash related transactions. What do? We take them off. So take note. So that's all. So it means that to get the operating expenses paid, I have to bring the expenses incurred less what? The non-cash item. Then you get it. Good. Now let's move on. Interest paid, the same show. Tax paid, the same show. You go through the same approach. Open balance. So for interest expense, interest paid, it will be something like this. Interest paid. The workings will be open balance. Open balance of the interest owing. It will be on the financial position. Please, all the open balance and closing balance on the financial position. And all the middle one is in the P&L. That's all. All the middle one is in the P&L. Open and closing, the financial position. That is it. So open balance, so much. Middle one, that's the interest expense. Interest expense in the P&L, so much. You add. Closing balance, you subtract. This is the interest paid. That's the same thing for tax. So this is how we are going to do all of them. The same thing for tax. So that is it. Thank you very much. Now let's go and then do justice to our question. Our what? Question. So be with me. Let the principal be with us too. No question, eh? If the expenses incurred less non-cash item, if there's any item which does not suffer cash, which does not have cash component, but they have subtracted it, what do? Take it off. I can tell you that, okay, total expenses incurred for the year, operating expenses incurred for the year is what? 6,000. This is the operating expenses incurred. Incurred for the year. Good. It's 6,000. This include the following item. This include, it means that I've added the following item to it. 1, depreciation of 500. 2, accrued expenses. Rent owing. Rent what? Owing of 600. Okay. Yeah, so to get the operating expenses paid is the expenses incurred less the non-cash item. 3, maybe there was a provision for bad debt. It includes a provision, increase in provision for bad debt of, let's say, That one is also 200. What again? The non-cash item, impairment. But all. So what do? We have to subtract all this because you've not made payment for this. We don't pay. We have not paid, but it has entered here. It is in because you've incurred it. Because the transaction should be recorded as and when they occur, or expenses should be recorded as and when they incur, when you incur them, not when cash has been paid. So it makes the operating expenses like contain some of the contain transactions or items that have not been paid for. You have to reverse all those ones. You have to reverse what they have added. You have to add back. Sorry, what they have subtracted, add back. Where they have what, add, subtract. That's all. So you are done. You can also talk about prepayment. So it means that the actual operating expenses that you are going to pay will be what? Putting all this together, 500, 600, 200. So making 1,100, 1,003. So I have to take 1,003 from this. When I take 1,003 from this, I get 5,000. So 4,000 what? 700. So this is what? Expenses paid. How do I get it? It's the expenses incurred less all non-cash item. Or what? Non-cash item. Good. So that is it. And then you are fine. And then we'll be fine too. Good. Okay, so I hope no question, right? Good. So if there's no question, now let's go and solve our own. Good. No question. No question. Okay, now let's go and pick our first illustration. Our first illustration. First illustration. Wrong. First illustration. That's cash flow. Good. Cash flow. Cash flow. Cash flow. Let's see. Target files, cash flow. Let's do this one. No. It's wrong timing. Good. So